Hello and welcome to the second video for Chapter 11 in Accounting 205. I'm going to start on page 1105 and we're going to first talk about organizational expenditures and startup costs. What they're referring to here is organizational expenditures are items like paying an attorney to incorporate you, and paying other costs, for example, paying fees to the state to get a certificate of incorporation, possibly getting somebody else to set you up as a corporation involving the issuance of capital stock, all that stuff. Okay, so all of those costs generally have to be amortized. Okay, and the reason for that is because they occurred before you actually started operating the business as a corporation. Okay, now by default, what you do is you incorporate or you deduct your expenses over 15 years or 180 months. Okay, so if you had $10,000 worth of startup expenses, all right, or organizational expenditures, you would amortize that over a period of 15 years or 180 months. Okay, it doesn't amount to much per month, but that is the rule. Okay, the IRS recognizes that a lot of companies, when they start up, are very, very small. So they'll give you a one-time expenditure of $5,000 in the first year, and you can just write that off, and then any remaining amounts would be amortized over the 15-year period. Okay, all right. And they give you examples in there that would define the difference between organizational costs and startup costs. Okay, all right. At the bottom of page 11.5. Okay, they talk about charitable contributions. All right. Now, there could be a lot of abuses with charity. For example, companies could set up, foundations strictly to receive donations from their other corporation, so the corporation can take a big tax deduction for that charity and then move the monies over into a not-for-profit. And which of course would not pay any taxes, assuming it's a legitimate not-for-profit. So to prevent that from happening, all right, Congress said, okay, we're going to limit charitable deductions to basically to 10% of taxable income. Now, if we take a look at the second paragraph under charitable contributions, you need to read that very closely, because again, this could be on your next test. So it says a corporation's charitable contribution is limited to 10% of taxable income computed before the deduction for charitable contributions, net operating loss carrybacks, capital loss carrybacks, and the dividend received deduction. Okay, if you're not sure what a net operating loss carryback is, what that is if kind of like capital loss carrybacks, it's when you have an operating loss in a year, all right, and you carry it back, all right, to a prior year when you had taxable income, and then what you do is you apply for a refund of the taxes that were paid in those prior years. All right, if you don't use up the net operating loss in your carryback years, then you carry it forward, okay, for a period of 20 years until that net operating loss is used up. All right, so charity, however, is different. Charity, you can carry it back, all right, for 3 years, all right, and then carry it forward for 5 years. Okay, all right. The next item that I want to talk to you about is on page 11.6. All right. Now, when we talk about that, we need to, let's go back and take a look at our tax return. All right, so I'm going to go forward to the pages in the book, all right, and we're going to go to page 1113. All right, go to page 1113. All right. This is Schedule M1, which we talked about real briefly in partnerships, but you see this being filled out more, all right, if on the on the corporate tax returns. Okay, now while we're actually looking at Schedule M1, okay, I would like you to take a look at the previous page and look at 11.2, and I'm going to highlight this as I'm talking to you because I want you to highlight this too. All right, so look at page 11.12, all right, and look at line 13, okay, and it says, are the corporation's total receipts for the year and its total assets at the end of the year less than $250,000? If yes, the corporation is not required to fill out the forms that are on the next page, all right, which is the Schedule L, the balance sheet per books, or the balance sheet you prepared in the financial statements. Schedule M1, the reconciliation of net income to taxable income, and Schedule M2, the schedule of unappropriated retained earnings. Okay, you don't have to fill those out if you can answer yes, okay, all right, to the question, are the corporation's total receipts less than, and assets less than $250,000? Okay, so most corporations, all right, are not going to be able to answer yes to that question. So we have to know how to fill out Schedule M1. Okay, so what you do is, all right, and this is one of the things I'll probably be looking at on the homework, all right, is you go to the M1 and the first thing you put down is the net income per books. All right, okay, if you were doing this for real, all right, what you would do is you would look at the company's financial statements, look at their income statement or their profit and loss statement or statement of earnings, whatever you call it, and put down on line 1 of Schedule M1 the net income per books. That's your starting point. Okay, all right. Then the next thing you do is you look at line 2. All right, when a company pays federal income tax, okay, they're going to debit federal income tax expense, credit cash, all right, or that's what they're going to do, or they'll debit, like income tax payable. It just depends upon what account they're using. Okay, depends upon if they made an accrual or not. All right, so any federal income taxes that they deducted for net income have to be added back. All right, you can't deduct a federal income tax on a federal tax return. All right, can't do that. All right, so you have to add that back on line 2, because remember, the goal of the M1 is to reconcile the amount on line 1 of the M1, which is net income per books, with line 10, all right, the ordinary business income of the company. All right, okay, so let's go back. All right, Schedule M1, line 3. Excess of capital losses over capital gains. Okay, well, the company would have recorded a capital loss on their books, but remember we said capital losses aren't allowed on a regular corporate tax return. All right, so we have to add that back. Okay, all right, okay, we'll skip over line 4 for a second. Then we says line 5, it says expenses recorded on books this year not deducted on this return. All right, so if the depreciation on the books was higher than the depreciation taken on the tax return, you would have to put an amount on line 5A. Okay, all right, any amount of charity that was deducted on the income statement in excess of the 10% of taxable income rule, all right, that we just talked about, would have to be added back on line 5B. All right, also remember that travel and entertainment and meals generally is subject to a 50% limitation on a tax return. All right, so the books would have deducted 100% of the travel, entertainment, and meals, but remember we can only deduct 50% on the tax return, so any excess that was taken on the books has to be added back on line 5C. Okay, then we go to the other side of the M1. It says income recorded on books this year not included on this return. All right, now the biggest example there would be tax exempt interest on municipal bonds. All right, well, that would have been included as revenue on the income statement, but it's tax exempt, so we do not have to include that. So that would be deducted on line 7. All right, and then line 8 would be any excess depreciation that was taken on the tax return greater than the amount on the financial statements. For example, Makers was taken on the tax return and Straight Line was taken on the financial statements. Okay, all right, so any excess depreciation on the tax return would go on line 8A. All right, and you know, what you're going to do is you're going to add them all up, and the whole idea here is that when you get done, all right, is that the line 1 and line 10 should reconcile against each other. So look at the examples in the book. All right, you'll see how all that works out. Okay, all right. Okay, so that's the M1. All right. Lastly, all right, let's talk about page 11.7. All right, page 11.7 tells you that the corporate tax return, all right, is due on April 15th. All right, it used to be due on March 15th. Okay, all right, but they a couple of years ago they flipped it. All right, so the corporate returns are now due on April 15th. All right, because they don't have individual shareholders that they have to report to. Now again, this is a subchapter C corporation where the tax return is due on April 15th. If you're filing a subchapter S corporation where the income flows through to the individual shareholders, the S corporation return is due March 15th. That gives the individuals a month to get the information onto their individual returns so they can file their 1040s. All right, corporations also pay estimated taxes. All right, the first 3 due dates are identical as the individuals. It's April 15th, June 15th, and September 15th. All right, for a calendar year corporation. The difference is the 4th payment. The individual payment is due on January 15th for the prior year. All right, okay, in other words, somebody filing their 2017 return had until January 15th of 2018 to make their last estimated payment. Corporations have to pay their last estimated payment by December 15th of the current year. Okay, that's the end of this video.